Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and global capital markets. I'm your host, Jill Malandrino, and joining us at the desk on the Nasdaq Market site, we have Phil Mackintosh, Chief Economist at Nasdaq, Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Steve Sosnick, Chief Strategist of Nasdaq-listed Interactive Brokers, and Chris Englebert, Founding Partner and CIO of Englebert Investment Advisors. We're here to discuss the optimism in the market, whether it's driven by strong earnings, the dominant theme of AI in tech, and how people are perceiving Trump's agenda. It is great to put the band back together and have everyone here at MarketSite. And Phil, it's been an interesting start to the year. There's a couple of conflicting indicators here, but it seems to be this week, a lot of it's predicated on what's happening from the political perspective in the US and earnings.
Well, I mean, which makes sense, right? Because a lot of things are changing in the political spectrum, and the earnings are coming out not too bad. I mean, the nice thing to see is actually there's a broadening of the earnings recovery. So we sort of were talking, you talked about the AI complex, the Mag 7 stocks really drove the market last year. We're starting to see an improvement in the other 493 stocks in the S&P 500, and there are more earnings coming through in the small cap space as well. So all good news from a fundamental perspective that helps, I guess, offset some of the shock and awe that's happening this week in terms of regulations. And I mean, all of the conference activities that I've been doing lately, nobody really knows what's going to happen, but there's a lot of uncertainty.
Yeah, there certainly is, because at the end of the day, it's all around execution, right? And that goes whether it's Trump or anyone else who's sitting in that seat, because it's one thing to make promises and have agendas. It's another thing to execute. Max, it's interesting, to Phil's point, what we've been hearing at conferences as it relates to AI and tech. The question is, what's the ROI, right?
Yep.
We have to start showing the receipts. And the other theme is, okay, now that we know who has the exposure to it, where are the derivative plays? And I think part of that is why you're seeing some broadening out.
Yeah, it's definitely broadening out. I mean, we talked about it last year, times when it was one of the top performers, utilities coming back into the forefront now. You're hearing a lot more, again, just the energy to power everything, the actual infrastructure to build these data centers. So it's the parts that build up to it's not just the chips and it's not just the models, but secured, the security for it. But again, the power that keeps being brought up, how much power all these data centers are going to take to power all these AI models, to build everything. There's such an incredible demand, and demand is not going to be stripped from anywhere else. We're not going to drive less or power anything else, so it's just being added on top of it. So again, those utilities and energy has kind of been that, energy has been the top performer so far this year after lagging last year. So again, that broadening out, because it's not just the chips that are powering it, it's the actual power behind it and the infrastructure that's building it all out. So that's where we're starting to see it kind of broaden out. And like you said, those are kind of the first order of the ROIs as the ones that are actually building it, because that's the upfront cost, right? It's not the, in the future we're going to start making money on the models, on AI. It's the actual building of it and powering of it. That's immediate. It's not really this is a 5-year plan. It's okay, this is happening right now.
Right. Well, it's moving so fast, and they're probably thinking about, or they should be thinking about, what their investments are going to look like as it relates to quantum, right? Everyone's thinking 3, 5, 8 years out, but guess what? That investment needs to happen now, because it's not cheap. Steve, it was interesting. We were talking on Friday about the inauguration taking place on Monday, and the markets were closed. I don't recall that, well, at least my 30-something-year career, of that happening. It's interesting, though, when your note came out and you took a look at customer activity, they're seeing the DJT stock as a trading vehicle, not an investment. Do you think that's a broader theme this week?
Well, first of all, our customers tend to be trading oriented.
Right.
So I can when I look at our numbers, I can pretty much differentiate what they're trading versus what they're investing in. And DJT was purely trading. We had that big run up, I guess was the Monday prior to the inauguration. It just sort of shot up one day, up 20%. When there's big moves, when there's big volume, our customers are very attuned to that. They jump in, they start trading. But by the end of like the 5-day period rather, they really hadn't taken on they hadn't built any net positions. They'd really just traded in and out, which is probably okay considering the stock basically gave back that initial gain fairly quickly. So I see that a lot. We're seeing a lot of real trading behavior. You mentioned quantum computing. Rigetti has been the number 3 stock on our platform pretty much since Google announced its chip breakthrough. because and it's interesting because Alphabet, Google is not really a very popular stock on our platform. It's not among the top 25, but yet Rigetti has been number 3 ever since, and along with IONS and QUBT, et cetera, those names have been all over the list since then.
Yeah, it really has been interesting. But Chris, you make a great point from a valuation perspective, right? The other half of the, the 493 of the S&P 500, they're trading at what, 19 versus 31?
Yeah, exactly, Jill. And so this is to your point. My concern right now is the speculative fervor that's going on in the market, not only in the equity positions where we're seeing outrageous moves, but over the weekend, Bitcoin, $ Trump, $ Melania, all these meme coins products came out, and I'm really afraid that investors, they're not investors anymore. We're getting a whole new class of traders, speculators, and unfortunately for those of us that have been around a long time, it always ends the same way. And to your point about the inauguration, et cetera, the attention span of people when it comes to politics is extremely short. And so all of this stuff is coming out that there's a lot of momentum, but you're talking about the first 100 days, what's going to happen. Well, the whole reconciliation bill isn't going to really come about till sometime in the second quarter. So a lot of this pent up fervor, people are like, hey, this is going to happen, this is going to happen, this is going to happen. And I'm like, we got to really wait and see. And to the point about AI, the big play was the utility stocks. I think everybody's looking for the next quantum computer, what's going to be. I think the most overlooked sector that's going to benefit from AI is going to be healthcare. The amount of cost that can be taken out of healthcare, whether it's AI reading for breast mammographies or for prostate cancer, it's done quickly, 100% accurately, and a lot of people are forgetting about that. And I'm saying, look at a lot of these healthcare stocks that have been tremendously beaten down because there's going to be a healthcare czar that may be coming in that's going to change the face of everything. We saw this movie again during Bill Clinton's era when they were talking about revamping healthcare, and the healthcare trade turned out to be the best trade for the next year. So
that's a good point that you bring up, because we just came back from CES, and I would say as it relates to industrial/automotive and healthcare tech, AI, that presence was really there. And when you think about it, whether it's being applied to financial services, cybersecurity, healthcare, the predictive technologies allow you to recognize vulnerabilities. How do you mitigate it, and how do you respond because of these types of technologies? So all that data that you're creating, structures around will allow physicians, surgeons to make those critical quantitative decisions.
The watch on your arm is a prime example. Yeah. The Apple Watch healthcare, they've been collecting this data now for several years, and you're going to be ending up going to the doctor. And again, I'm not a doctor, but I can play one on TV. But you're going to be going to the doctor. They're talking about now that they can use AI's predictive ability to determine diabetes from your voice recognition. Right. So again, if you want to drive and take healthcare costs out and increase multiples rapidly, I think that's the area that everybody's overlooking right now is the healthcare.
And there's been a couple of events leading into CES, Max, showing the frustration that Americans have in the U.S. healthcare system. When you talk about efficiencies and the roadmap is there, that policy is going to have to evolve along with it, because the technology is there. To Chris's point, they do have that constant communication with your physician available now, which, by the way, will help the 15,000 physician shortage that's coming in 2030.
Yeah, I think that also then focuses on data privacy and protection. Having everything at your fingertips is fantastic, but you also have to be able to protect it. It's one of those things, I think, like you're talking about with regulation and how quickly everything's expected to happen. That's one of the things that we've spoken with companies about, is what to keep an eye on, what everybody kind of thinks is going to happen. We really need to go out and see the execution and how they're going to treat everything. Interested to see, like you said, it had a similar scenario with Clinton administration. We'll see again now. It's a big question mark what this new administration is going to do. Are they going to allow it? Are they going to try to incentivize that? Or is that focus going to be top of mind for healthcare providers? Again, the difference between the providers versus the insurance. There's a lot of kind of ducks that need to get in a row just because the technology is there. I'll be interested to see how quickly they actually implement it. Again, the whole telehealth complex really took off during COVID, making everything easy at home. That potentially that leg could pick back up now again with the advent of AI use cases for it. You could do a lot more at home. Having a Zoom call with your doctor or with an AI agent potentially helps, again, sort of mitigate stuff in the beginning, but it's interesting to see how quickly it actually comes into play.
Yeah, and Phil, Chris and Max have both made parallels to the Clinton years. Are there any other points in the macro, point of view that you follow that parallels to where we are today?
What I think is interesting is thinking about the internet growth and how that created a productivity boom. And now we look at where we are with demographics, and almost every continent around the world is not having enough kids to replace the population. So the population is going to get older, there's going to be less people working, and at the same time we're running quite high deficits, a lot of government debt that's going to have to be paid back. Really, AI could be the thing that saves the world, because it's going to help us increase productivity and keep GDP high even as the number of workers is falling. So I think we're starting to talk about like the spend on AI and the second order effects, but hopefully the fourth and fifth order effects are productivity gains, where we don't need as many people to do as much stuff, so that the world can actually grow its GDP. Across a lot of industries, there's probably going to be savings that we can make, or more things we can do with the same number of people. I know we talk about diagnostics with medicines. I think lawyers are another area. Anyone that's got an office job really should be able to be much more productive if they can just get AI to compile the facts so they can make a decision rather than spend days compiling facts. So the productivity gains that we saw in the internet were great for getting GDP to grow, and hopefully that's something we can see again as population this time is shrinking.
And that's what makes me excited about some of these technologies, because not only do you get things done quicker, but you can focus your energy on, let's call it better R&D, more strategic solutions and so forth. It's interesting, Steve, again, while at CES, and we covered a lot of the automotive tech and innovation, safety innovation, that from, traditionally it's 5 years from concept to the finish line, 2 years now. That's how fast it is evolving. So to Phil's point, we're going to need some assistance from the machines to be able to keep up with that.
Well, that's really the key. And while I'm not going to, while I think Phil's point is well taken, the question is timing, because are we expecting this to occur more quickly than it can? And I think back, and the precedent here would be sort of the internet era, where I will stipulate that all the enthusiasm that we saw in '99 and 2000 regarding the internet came true, and then some. That I will say is 100%. But the stock market was way ahead of the real world, and it took longer for those gains to manifest themselves. Now, to some extent, the companies now are much bigger and better suited toward implementing them. So it's many of the upstart companies that people fell in love with then, which to Chris's point was pure speculation. Those fell by the wayside. But for the most part, that's really the crux here, is how much good news is being priced in and how quickly is it being priced in. I will stipulate that some good news needs to be priced in, because it does have the potential to really reshape the economy and the way we work and think.
Yeah, and Chris, but we kind of have, I think I know what you're going to say here, we kind of go through these cycles.
Yeah, well, what I'm concerned about is, so we've had 2 years back-to-back 20% plus gains in the S&P 500. Retail and institutional investors haven't really seen what a down market looks like. And so, you get a 5% pullback and it's bought, the dip's bought, we go up to new highs, you get a 10% pullback. And I'm saying, and again, from a statistical probability, the last pullback greater than 20% was February of 2020. So, one of the things that everybody was looking at for last year was black swan events. We had 2 global conflicts. We had a presidential election. Everybody's like, something bad's going to happen, something bad's going to happen, and nothing bad happened, thank God, which is what we want to have. But now nobody's really looking at any black swan events. I mean, let's reel back China. China's still in a deflationary environment right now, and Apple's making noises that, and if you look at Apple stocks recently, it's still about the consumer. It's still about selling their product, and there's kind of a daisy chain effect between all the Mag 7 stocks doing business with each other. NVIDIA sells chips to Amazon, Google, et cetera, Apple. And if any one of them, to your point, talks about CapEx spending and just whispers next week when they talk about earnings that we might have to pull back our CapEx spending, that's really going to be, I think, the most interesting part of 2025 so far.
Yeah.
I think it touches on the breadth, though, like where you want to see breadth start to improve, like we were talking about with earnings. We always talk about kind of the headline numbers. S&P has had back-to-back record, great years, But again, when you kind of go under the hood, it's the Mag 7 versus the other 493, or looking at the Russell 2000 versus the S&P 500. We've been talking about it, I feel like, for 2 years at this point, waiting for the Russell catch-up trade, that it's going to be time for Russell and the small caps to catch up to the mega caps, and it just hasn't happened. Every time you think you're getting to start okay, it happen, it turns. So I definitely worry about Mag 7, but if we start to see that breadth improve, you know, if you were just a small cap investor, you didn't have these record years the last 2 years, you're not trading at all-time highs, you didn't have that same, you know, kind of huge years and record profits. So I think, like you said, the daisy chain of the Mag 7 potentially could be an issue for the broader index, but again, if we start to see earnings really start to broaden out and start to see small caps catch up a bit, obviously rates need to participate as well and have help there. But again, if we have a little less volatility there, I think companies are able to navigate through that. That would be helpful to see that kind of catch-up trade. But that's kind of what we're looking for this year, is hopefully, again, maybe year 3 is the lucky year, but small caps catching up to the large and mega caps, which we haven't seen.
But to your point about breadth, it's really largely a lot of days it's been uninspiring. We went through essentially most of December, I think the first 2 or 3 weeks of December, where you had every single trading day had fewer than 250 stocks up in the S&P 500. Today, when I checked earlier, I hadn't checked, you know, in the last hour or so, it was 75 of the 500 stocks were higher. But the correct of those 75, the correct stocks were higher, which kudos, because they're all Nasdaq listed. But those are the ones driving the bus. And the flip side of that is, if there's any shortfall in CapEx or in guidance, that can get pretty ugly because you can get a stampede to the exits. I'm not foreseeing this, but it's just sort of this elemental risk that, you know, if people just sort of say, you know what, I bought zillions of dollars worth of NVIDIA chips, I'm going to slow down those purchases for a while and figure out how to turn those into productivity. That's got a spillover effect into a lot of different places. I'm not using this as my base case, but as someone who really, you know, most of my career was really spent as a market, you know, managing the risk of a market making firm and always thinking about what could blow us up. Right. And what could I avoid? That to me is the biggest existential risk. We were lucky today with Netflix because they actually guided their earnings estimates lower. They guided their revenue estimates up very slightly, but of course the headline, which was a really good headline, was we have twice as many subscribers than you guys thought. So of course that papers over it. But I think if you start to get poor guidance talk when you have an S&P that's pricing in between 13 and 15% earnings growth for the year, that leaves you a little vulnerable. And again, this is not my base case, but it's the thing that, from a risk management point of view, you have to be cognizant of that.
Right, and I think that's a great point. The other existential point, Chris, is perhaps the market is thinking, okay, we have, you know, a new administration coming in, might be some volatility, might be a lot of opportunities. Well, the first couple of years of Trump 1.0, what do we move, 4 or 5 handles a day? Right. And there was no vol until December 2018 when the tariff war started to heat up. Right. So maybe sometimes be careful what you wish for, because if you don't get it. Yeah,
and that's my point. And so one of the things, we look at a lot of the different asset classes of returns, and, you know, everybody's saying, is the 60-40 mix of stocks versus bonds dead? I'm saying, well, now that bond yields are that much higher, it makes a lot of sense. And if you look over a 20-year period of time, typically bonds outperform stocks 4 to 5 years out of that 20-year period of time. In the last 20 years, we've had 1 year where bonds have outperformed stocks, and that was when the stock market was down, and so was the bond market. So if you look at the landscape of what's expensive and what's cheap, bonds look pretty cheap right now. You know, I keep saying this because we deal with large pension funds, is everybody's like, wow, 7% mortgages are bad, you know, for you know, anybody trying to buy a house. They're not bad for a pension fund that's got an actuarial assumption of 6.5%, because they're getting 7% on a mortgage investment is what they're doing. So, you know, 2025 could be the year of the bond.
Yeah, well, Phil, we're going to give you the last word here, but when you think about things that did not come to fruition, you know, inverted yield curve, no recession. There's a lot of indicators, you know, classic indicators where nothing, you know, what was it in 2023, 95% of macro analysts predicted a recession. Yep,
no recession, pretty much around the world. Yeah. All the economies are growing. Not so strong for most part, but everything's growing. I still worry a little bit about the drift up in 10-year yields, though. I think whether it's a credit being priced in, or just the level of debt that we've got, or tariff risks and inflation risk, whatever it is, there's a lot of small companies with a lot of variable rate debt and pretty close to maturing fixed rate debt. So we just talked about how they haven't seen the same recovery. Their margins are a bit tight. I mean, how much longer can they hang on before they start thinking about their margins and maybe laying people off, which would be the unexpected risk that we haven't started talking about.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.